Welcome to Behavior and Risk, where we explore the intersection of decisions, the brain, uncertainty, and the business world. I'm John Burkhart.
And I'm Rich Loria.
We're glad you took a chance on us today.
Hi, welcome to another edition of Behavior and Risk. Today's topic is about floods. And more specifically, it is about a very important government program called the National Flood Insurance Program. Here in the United States, flood is not a new risk. In fact, it's a risk that's been around for eons. However, the risk management of floods is something that has waxed and waned over the last century or thereabouts. Early in the 20th century, as property insurers were getting a foothold in the market here in the United States, they realized that including flood events in their policies was not a profitable enterprise. Therefore, they made the decision as an industry to exclude flood events from traditional homeowners policies. That left a tremendous gap for many homeowners throughout the United States, especially those along coastal regions and those nearby rivers and other tributaries that have flooding events every so often. The government recognized this and decided to step in, seeing the massive gap in protection for its populace. In 1968, it introduced a fully government-run program referred to as National Flood Insurance, the National Flood Insurance Plan. The program has been around now for almost 6 decades. And unfortunately, it's a program that has only had limited success in closing the gap. We'll talk more about some of the reasons for this, as well as provide some details as to where it is falling short. And in addition, we will cover some of the behaviors that are going on and perhaps some remedies for dealing with these behaviors in order to improve its performance.
This is a topic that is near and dear to both Rich and I. And in fact, I believe it's one of the earliest conversations that you and I have had with each other, going back to when we first started working together back in 2019 or so. The NFIP is a curious beast for many reasons. It has some very peculiar structural aspects, and it directly interfaces with some very odd and perhaps easily influenced or easily biased human behaviors and decisions. And all of this aggregates to make the NFIP a perfect encapsulation of the intersection of behavior and risk. I think it's really not an exaggeration in any way to say that our conversations around the NFIP led directly to our broader view of the entire notion of behavior and risk. And it's very difficult to know where to start because there are so many different things that we could talk about with the NFIP. But as I see it, there are structural and operational issues that the NFIP has, and that's being kind. Let's call them what they are. Structural and operational problems with the NFIP, as well as behavioral issues that, in my view, largely amount to a failure to really understand how and why people select products in general and select risk products in particular. We have some window into this, having worked on projects around the NFIP, and while we're no longer involved with that, we have seen historically the NFIP's approach to resolving issues of uptake and revenue and policy saturation is essentially characterized as, well, let's just communicate more. And for reasons that we'll go into, this does not do a whole lot. As I said, there are numerous dimensions at play here, and I think it might be best to start with some of those structural challenges because I think those directly feed the more behavioral issues that emerge with the NFIP?
Those are all great points, and I like the idea of attacking this from a structural standpoint. But before we even get into that, I just want to build a little bit more, because when people ask me, whose fault is it that the NFIP is not more successful than it currently is? And the normal answer that comes out is, oh, it's because it's a government program and government programs don't work well in general. And while I do think there's definitely aspects of that in this shortcomings, I would say when I think of the various stakeholders involved, whether it's the general public slash policyholders, whether it's the people running the program, legislators, real estate folks, as well as the private insurance market and its role in the National Flood Insurance Program, as well as also now being a competitor to the National Flood Insurance Program, I say they are all culprits in this in one way, shape, or form, each bringing certain biases into the flood calculation that actually serve to make things worse than they would be otherwise. So, from my standpoint, as I see it, I wouldn't blame any one group involved here, any one set of stakeholders. I think that there's something to be said for each one. And that's another way we could go about it. But I'm willing to start with the structural approach, and then I'll weave in some of the stakeholders involved in it.
Well, let's be very clear up front here that the structural, regulatory, operational, and behavioral issues and all the disparate stakeholders, you can't realistically untie or separate them all. It's all a major interplay, which I think is why this is such a thorny problem and such a challenging issue to resolve. As I'm saying this, I'm realizing we should perhaps also offer some caveat to our listeners that we've been talking about the NFIP not just with each other, but in public facing events and in forums and in seminars and webinars for a long time now. And it's possible that we're going to shorthand or gloss over some terminology or assumptions just because we've done this so often. So, listeners, apologies ahead of time. And if anything does become unclear, please go ahead and reach out to that email address that is listed in the podcast description. But Rich, yeah, let's go ahead and maybe start with structural, just because I think that's usually easiest for people to ease their way into.
Agreed. So one of the first structural issues that I think is very important is the fact that the program is largely optional. Now, coming from the insurance world as I have, one of the things that you always worry about with any type of optional coverage is the behavior driving why someone will buy something that they don't have to buy. And that drives into two things. The first one being adverse selection, meaning that the people who buy the coverage are those that perceive that they need it the most. And usually, although not always, John, those are the folks that are typically the highest risk. And what does that do? Well, that's going to overall drive up the underlying cost of the program, because you're not going to have what we like to call in the insurance world the spread of risk, which ideally you want, because by having folks who are lower cost as well as higher cost, then you're able to have some type of subsidization that allows for the overall cost of the program to be manageable and affordable to everybody involved.
And I think this is exacerbated even further by a curious aspect of the NFIP, which is that it is not available to all United States citizens. It is only available to citizens who live within what is classified as a special flood hazard area, and even more specifically, within these special flood hazard areas that have municipalities that have met certain requirements and regulations in order to qualify for coverage with the NFIP. The fact that, by definition, accessibility to the NFIP depends upon residing within a hazard area completely fuels that adverse selection effect, where you know for fact that the people who are eligible for these policies are those who are overwhelmingly more likely to experience a flood event.
Yeah, and the data supports that those who are selecting the coverage are those who perceive that they have the highest level of risk. And this gets into one of our favorite heuristics that people use, which is the availability heuristic. And that typically these are folks who either have experienced the flood themselves or know people who've experienced the flood. And often those flood events have occurred recently. So all the aspects of availability that we have talked about, including the recency aspect as well as the saliency aspect, because again, if the flood happened on the other side of the country, you're probably not going to be worried about it. But if it happened in the next county, then boy, you're concerned about it. Or at least you're going to certainly pay more attention in terms of considering your risk.
And here we see why it's so difficult to disentangle the structural from the regulatory, from the stakeholder to the behavioral elements, because these all connect together. The structural aspects of the NFIP directly fuel this adverse selection, which is compounded by the availability heuristic. And I'm going to push back a little bit, maybe, in the sense that there is this curious asymmetry between those who hold policies and those who don't hold policies and their perceived belief as to how likely they are to experience a flood. We have reasonably good data on that. About 1 in 4 non-policy holders believe that their home is likely to flood. About 3 in 4 policyholders believe the same, that their home is likely to flood. Now, this is absolutely fueled by availability heuristic. If you have experienced a flood or you know somebody who's experienced a flood, you have a high degree of salience and a high degree of recency that will make it far more likely, or maybe not far more likely, but will definitely fuel your probability assessment as to how vulnerable are you to a flood. But there's also a measure of behavior fueling attitude. This is one of those curious behavioral phenomena where doing something actually changes your attitude around it, not the other way around. And this is something that marketing people find horrific because most of them believe that if you change their attitude, behavior will follow. But the data suggests quite the converse. What I'm not sure about, and I don't know if we really can get at this data in any good way without some sort of serious psychology laboratory experiment, is how much of that belief aspect is a result of owning a policy. We know there is some regulatory requirement, especially if you have a mortgage on your home. Typically, this is enforced through bank lenders and mortgage brokers. How much of this perceived difference in flood likelihood is simply because I have a policy? If I have a policy, does that then make me more likely to believe that there's a reason that I have this policy? I'm not sure we can fully disentangle that, but it does create some interesting challenges in terms of assessments of probability.
I've never thought about it quite from that point of view, John. And there's two ways I can think about it. One direction is to go towards confirmation bias, that the purchase of a policy in and of itself confirms an inner belief that, yeah, I'm in a place where I could be flooded out tomorrow. So there's that one aspect of it. The other aspect, which takes us in a completely different direction, is the issue of moral hazard, in that the purchase of the policy leads one to believe, okay, well, I'm protected now. So I don't have to do anything special to where I live to prevent a flood from creating a lot of damage. So it's almost like a feed forward type of thing that I've got this policy, I'm good. Let it rain, let it pour, let the heavens open.
And I'll confess, I do suspect that most of it really is due to availability, salience and recency in particular. I don't think that the behavioral inference is a huge influence on whether or not people believe their home is likely to flood. And the reason I say this is that we have definitive cases looking at the data where you have communities that historically have experienced floods and hurricanes and various water damage events. Homestead, Florida, of course, is the
Mhm.
example we keep coming back to. And within these communities, we see disproportionately high uptake of flood insurance policies. I raise the inference issue as more of a thought starter, but I think the data does largely support the fact that, or the conclusion rather, that people are heavily influenced in their assessment of flood likelihood by what have they experienced before and what do people they know experience around them.
And it's interesting that you bring up the Homestead example because how long ago was the Homestead
92?
flood? Yeah,
It
that
was early
was,
90s.
and so yes, I believe you're right. So that was Hurricane Andrew, right, in 1992.
Hmm.
And so that we're talking over 3 decades ago. So this gets to something that even I make this mistake quite often is associating availability with recency. And that example clearly throws that under the bus because with regards to the folks in Homestead disproportionately buying flood insurance, even though the last major event was 30 something years ago, means that the event itself that occurred must have been so horrific that they'll probably never forget. And that even over time, as people come into the neighborhood, there will be reminders from those who were still there, who lived through it, or who knew people who lived through it that will say, yeah, it can easily happen again.
And that's a very important point. You're absolutely correct. Recency is part of the availability heuristic, but it's not the entirety of it. Salience is a major element. That is to say, how strongly do you feel something? How viscerally do you experience it and remember it when it's brought up? And yes, Homestead and Hurricane Andrew, there's not a lot of recency involved there, but there is definitely a degree of visceral salience. I never even lived there, and I still remember the pictures, I believe, on the cover of Time magazine of these homes that had been absolutely leveled and washed away, and where you had trailer parks, there was now just a green field because of all the water damage and flooding that occurred there. We see similar things with the 9/11 attacks. We still make policy on the 9/11 attacks. We still talk about business terrorist risk packages around the 9/11 attacks, despite the fact that it's almost 25 years ago now. This has very low recency, but very high salience. So the availability is still high. And this is something that no matter what particular topic we're discussing, anytime we're talking about risk perception, we need to keep in mind that there are different dimensions of availability that can occur either in contradiction with each other or in support of each other.
Yeah, and that gets into the whole risk appetite question, which is really the fundamental question about what's driving uptake or lack thereof in different flood hazard zones. So, in the case of what's going on with Homestead, because of the saliency of that catastrophic event from over 30 years ago, the perception of the risk remains high, and therefore the mitigation against it. Whereas in other parts of the United States, that perception is not the same, particularly in areas that are not near coastal regions where there may not be as well known flood events going on, even though there are flood events even inland, and they're actually more common than people think.
I'm reminded of, I can't even place the date, but there have been a number of significant floods in the St. Louis area because of the Mississippi River. We don't typically think of someplace quite so far inland as being a flood hazard area. And in fairness, I don't know if it's classified as a special flood hazard area by the NFIP, but it is a region that, because of quirks of geography, absolutely has a greater likelihood of flood than perhaps Tempe, Arizona. And this creates all kinds of interesting impacts on how people choose or don't choose to select flood insurance coverage. We've sort of talked around, but I think it's important that we state this outright. The NFIP has a problem. And the major problem it has is that there is a very low uptake rate of flood coverage policies to the point that when there is a major flood event, they risk going insolvent every time that there is something of that magnitude. And as a different shape of problem, you simply don't want people to be out of their homes, regardless of the solvency of the fund. And we can talk about the federal disaster relief issue on top of this, which is a definitely a fuel of moral hazard. But the broader question of why do people not choose to purchase NFIP policies, I think is a really important question. One, for understanding human risk decision making, and two, more specifically, for anybody involved in the selling or pricing of any shape of insurance or risk product, because these lessons really do generalize to any of those domains.
Yeah, before I respond to that directly, John, I do want to push back a little bit. You said something about the solvency of the program.
Mm-hmm.
Well, this program, as far as I understand, owes the federal government 21 billion. So it's already insolvent from a technical standpoint. It's just being propped up through appropriations from the Treasury. So this thing it has long stopped being self-sufficient. It would probably take many years of adequate performance, meaning that they're bringing in more revenue than they're paying out in claims for them to be able to pay back what they owe to the US government. And that gets me into another thing that I don't know that we've ever talked about before, John. And
Hmm.
we'll get back to your other question in a moment, but I wanted to take this moment to introduce it, which is the idea of mental accounting at the government level.
Interesting.
And the idea of fungibility, that part of the issue going on, as does happen with a number of government programs that are woefully underfunded, is that it can't stand on its own 2 feet. And because it's been propped up through special actions by Congress, it continues to exist. And therefore, there's reluctance to take the rates to a place where it can be self-supporting.
It's funny. You're right. We've never talked about the mental accounting aspect of this amongst ourselves within the context of the NFIP. But as soon as you brought it up, I knew exactly where you were going with it. And I agree. Federal procurement is a very strange beast. And when you are at the policy making level or at the legislation making level, I don't think that there is a whole lot of consideration of the particular details of how much money is going to each specific program. The NFIP exists within Department of Homeland Security at present. Hasn't always been the case, but for the last, call it 15, 20 years or so, that's been its home. And Homeland Security is very well funded. There's all kinds of money flowing through Homeland Security. And so if you get to oversight committees, it's very easy to look at NFIP, which sits under FEMA, which sits under Homeland Security, and conclude there's plenty of money available. I'm reminded of that wonderful quote by the late Senator Everett Dirksen, who said, "A billion here, a billion there. Pretty soon you're talking real money."
That's a great line. I definitely love that line. And it's so true when it comes to the federal government. I would say at some point in the near future, the billion will be replaced by a trillion, but I digress. Anyway, the point here is that there's really not a lot of incentive to do anything about it. And in fact, I would argue that the Rating 2.0 project that began a few years ago, which has attempted to right size some of the rates and bring more equity among different classes of policyholders under the NFIP, has served to exacerbate the problem and encourage more adverse selection. Because I know from my experience that when you jack up rates by high percentages, that some folks, if they have the option, are not going to continue with the coverage because they'll view it as unaffordable. And a lot of that is driven by anchoring. that once we get used to paying a certain amount for a coverage or for any good for that matter, any type of large increase is going to be viewed just, I think, almost in a knee-jerk reaction as, oh, well, that's not what it should be. I've been paying something much less for a while. So it's a situation that I think would take years of careful planning to ever work its way out of.
Well, let me put a question in front of you around that. Do we really think that adjusting rates is going to meaningfully change uptake in one direction or another? Obviously, if you make them too expensive, you'll drive everybody out. But in the sense of tweaking rates, call it 5% or even 10 or 20%, is that really likely to drive a major shift in uptake or policy penetration? I ask this because I'm looking over my notes here in front of me at some of the major behavioral phenomena we've observed, and cost is really not a major factor for most of these things.
Well, yes and no. I agree with your premise that these adjustments that I'm speaking to will not improve the fundamental problem that we've introduced in this podcast, which is the uptake. It definitely won't. And if anything, it might even hurt it slightly, might even make it a little bit worse, because even modest increases could drive a few people on the margin away. But that's neither here nor there. My point is that over time, it's better if this program eventually gets to a place of self-sufficiency, because that's going to help remove and extricate some of the other problems that we've already talked about. However, I'm the first one to admit that that's a long-term plan. That's not going to really move the dial much, but I would suggest that there be movement in that direction, along with a number of other things that will have more of an impact in the short run.
Okay, I think that second part of what you just said there is crucially important because I don't think they can make the program solvent on its own purely by adjusting rates. You have to increase the rates phenomenally high in order to do so. And in doing that, you will drive more and more people away from participating in the program, which will then entail an even greater need to increase rates. So without addressing these fundamental behavioral issues, I really don't see any long-term solution through the rates alone. But as you said, there are a number of other things that they need to do in conjunction with adjustments to the rates. And that I absolutely agree with.
Yeah, and I think if you want to solve the rate issue, you need to get a spread of risk, which means bringing more people into the program in some way, shape, or form. In effect, that is already going on today. It's just that it's being done using implicit subsidizations from the US government. So you and I and others are effectively paying, although we don't know how much we're paying. Part of our taxes are going towards subsidizing these rates. So it's already occurring. It's just not being done explicitly.
So let's talk about bringing more people into the program. I think that this ultimately is the goal that the NFIP has before itself and needs to resolve so that it can be solvent and not a drain on federal assets and not exceed its own budget. To do this, I think we need to ask ourselves, why do people purchase NFIP policies and why do people choose not to purchase NFIP policies? We know that there are some asymmetries already looking at the data. It's not as though it's just some people choose to and some people don't. Interestingly, we know that income and wealth does not really seem to be a major factor. We haven't seen in the data significant deviations in terms of higher income or lower income people purchasing NFIP policies or flood insurance policies in general. Where we do see some asymmetries is geography. As we said, there are certain regions where if there have been significant flood events in the past, people are more likely to purchase flood policies. And in something of a surprise, when I first read this, younger people and minorities tend to purchase NFIP policies at a higher rate than average, than national averages. This is really interesting because the simple hypothesis, absent any other consideration, would be people with more available wealth will purchase policies because they have more available income and they want to protect what they have. This is not what we see. On average, younger people and minorities in the States, and when I say minorities, the data shows in particular African Americans and Hispanic Americans purchase flood insurance policies at a higher rate than national averages. African American and Hispanic American populations on aggregate tend to have lower income compared to national averages and compared to white and Asian populations. And this goes directly against the hypothesis that it's a money issue, that if you have money, you'll spend that money in order to protect what you have. That's not what we're seeing. That's not what the data shows. Instead, we see this asymmetry where these individuals actually are more willing to part with their money to purchase these policies. And I find that really interesting.
I do too. And I wonder, can it be explained not through the loss domain of the prospect theory curve, but through the gain domain?
That's exactly where I was going with this. I think prospect theory explains all of what we observe here through endowment and through issues of reference points. The endowment effect refers to the observation that when you own something, you believe it's worth more than if you're just looking at it in isolation. If I'm looking at a smartphone on the shelf in Best Buy, I'll look at that and say, okay, it's $750. I believe that is worth $750. If I have purchased that same smartphone myself and somebody asks to buy it off of me, I'm going to ask for more than $750 because parting with it represents a loss. And we know there is loss aversion. There's an asymmetry between perceived gain and perceived loss. And so in order to part with it, I need more than that value that I paid. Homes are some of the most expensive things that any of us ever purchase. If we put down, I'm not sure what the national averages are right now, but I live in Boston, so I probably have a very skewed perception of what homes are worth. But let's say if you spend $500,000 on a home, once you've bought it or gone into a mortgage for it, you're going to perceive the value to be substantially higher. You're going to perceive the value to be 600, 700, perhaps even $800,000, and therefore much more inclined to protect that value. And then this is further amplified, I think, by the notion of the reference point in prospect theory. Prospect theory talks about how we don't calculate absolute gains or losses. We calculate gains and losses relative to a point where we exist here in the moment. I would hypothesize that people of lesser means and lower income, a home represents a far greater proportional purchase. Even if it's a cheaper home compared to somebody who earns $1 million a year, as a percentage of their net worth, as a percentage of their assets, it's likely substantially higher. And therefore, the endowment becomes even stronger because relative to their starting point, this home is worth incalculable amounts. And therefore, I think that probably fuels a great deal of receptiveness towards purchasing a flood insurance policy.
Yeah, I think that's all on point. I think folks of more means, in many cases, will have multiple homes. So having one home flood is not going to be as significant a hit to their overall financial wealth as it would be to someone who just owns one home of more modest means.
So this implies an interesting approach that NFIP could take in terms of driving uptake, which is to, rather than just say, hey, please buy more policies, here's how you can buy policy, specifically to message towards people's perception of the value of their home. By increasing the perceived value of the home, if our hypotheses around this are correct as to why younger individuals and minorities tend to buy more flood insurance policies, anybody experiencing an increase in the perceived value of their home would then be more likely to purchase a policy.
Yeah, so I agree with that. And I would go a little further that one of the things that they could do is make the policies bigger than they currently are. Right now, the maximum payout is, I believe, $250,000 for the home itself, and I think 100,000 for contents, if I'm not mistaken. And those limits have been around for years. They have not been indexed to inflation. And I think, as we all know, there's been quite a bit of inflation, especially in recent years. But even in previous years, there's been ongoing inflation. So many of these homes, even those with those of more modest means, are not going to have full coverage if they buy a policy from NFIP. So that's going to be somewhat discouraging, because why are you going to buy a policy, spend money, and then if the event happens, you don't even have robust coverage? You still need to pay a lot out of your own pocket.
And I think that can be made even more effective by greater communication around federal disaster relief. We've hinted at that earlier in our conversation, but we never really got around to explaining what the problem of federal disaster relief is with NFIP uptake. The short version, of course, is that anybody who lives within an area that is declared to be a federal disaster zone or a federal emergency area is entitled to apply for federal disaster relief. And we've seen from interviews and from research that's been conducted that people are aware of this and have a perception of, well, if I can just apply for this, why would I pay for a flood insurance policy? Why would I choose to pay out monthly when I can just apply for the disaster relief after it happens? Of course, there are some factual issues with disaster relief that are a problem, which is there's no guarantee of what the time frame will be in terms of when you will receive a payout from federal disaster assistance or federal disaster relief. And there's not really a fixed amount. It's a percentage of whatever pool is made available for a particular emergency. And this is almost never anything approaching full value of home. And so by clarifying what the limits of federal disaster relief are, in conjunction with making the NFIP limits higher and making that publicly available, this becomes a much more straightforward calculus for people to perform, rather than against guesses and optimistic inferences and their own hope about what they want it to be.
Yeah, so unfortunately, the existence and the perception of federal disaster relief without having to buy a policy really plays into the combination of optimism bias and narrative fallacy. The optimism bias first starting off with a thought of, well, this can't happen to me. And if it does happen to me, the government will come and bail me out. All I need to do is apply for the funds, go through the process, I'll be good. Without understanding the many points you just brought up. And one other thing I'll just add to that is that there are studies that show that 90% of businesses that suffer a flood event, even though they qualify in most cases for federal emergency funds, they go out of business within 6 months. That is a shocking statistic, and therefore really harpoons the optimism around federal disaster relief and being able to stay afloat and keep moving forward.
I would be fascinated to see a breakdown of that figure. It makes sense if you consider that a huge number of businesses are small businesses and micro businesses. That is to say, they have 5 employees, 3 employees, or 1 employee. And if you're trying to care for your home as well as your place of work, yeah, it's really easy to see how you can then just get absolutely buried. And you're right, federal disaster relief is not going to be nearly enough to keep both of these going. And that becomes a double hit, because from the point of view of the government, because now you're paying out and you're losing taxable income.
Yeah, it is a double whammy in that regard, and a very unfortunate one. So this idea of Uncle Sam being there, and this gets into another aspect of it, which is the time domain. And one of the main reasons that these businesses, especially these smaller businesses, wind up going out of business when an event like this occurs is because the bureaucracy and red tape are so significant and take such an extended amount of time to work through that these businesses can't wait. It's either you're going to hang on to whatever savings or capital base you need to support and get your operations running until the government comes through, or you close up shop.
And of course, because of this interplay of optimism bias and intertemporal discounting, people are not making that calculation in their head when they are deciding, or not even deciding, but simply going with the inertia of, I'll just go ahead and apply for federal disaster relief if anything bad ever happens. In their head, it's all a distant future outcome. And this gap between the event and the receipt of funds is not really considered in any way.
No, it's definitely not.
So, in a paradoxical way, we can say that federal disaster relief and the availability thereof really is a problem for driving the, let's call it, safe and responsible deployment of flood insurance policies.
Absolutely. But I'm not sure, going back to your earlier point, that changing the messaging around this does any good.
No, none of this is calculational. And the fact that we don't see differences across income brackets tells us that this is not calculational. This is based on perception and risk appetite and the heuristics that we use to make the judgments around what we want. Insurance in general is problematic. This is true across any domain of insurance. And without any sort of regulatory enforcement, people just generally tend not to purchase insurance. People don't want to spend money. They don't want to experience a known and certain loss against a potential possible future loss that they're going to most likely judge as low probability. And flood insurance and the NFIP in particular are exacerbated by so many additional factors as well. You're right. Messaging and informational clarification in and of themselves are not going to really move the needle in any meaningful way.
Yeah, and one other thing regarding probabilities that I want to just explore for a minute that I thought about that I don't think we've mentioned in this context, but I wanted to get your views on it.
Hmm.
Most of these flood zones, or SFHA, are evaluated and identified based on having a probability, a 1-year probability of a flood occurring equal to about 1%. Now, if you have a 30-year mortgage, believe it or not, you have a 26% chance of having a flood event over the course of that mortgage. I'm not sure how many people really understand that, John, and whether there is anchoring. If you were to ask them, what's the likelihood, given that you're in a flood zone of a 1 in 100-year flood zone, if people would be able to make the mental calculation that there's a more than 1 in 4 chance that they're going to experience a flood over the lifetime of their mortgage.
I would say almost certainly not. You nailed it with anchoring. If it starts from a premise of 1% chance on a 100-year flood timetable, that's going to be the cognitive anchor. We know from generations of data that people don't adjust their anchors appropriately. We know that when you're asked to multiply, for example, in your head, 1 times 2 times 3 times 4 times 5 times 6 times 7 times 8, okay, give me an estimate in the next 2 seconds. People tend to be off by 1 to 2 orders of magnitude under where they should
Yeah.
be. And this is amplified by just the simple fact that doing math in your head is hard. And doing probability is even harder. We've hinted at, and I think we might have even specifically addressed it in previous episodes, that we're not evolved for numericity. We are not evolved to do calculations around numbers in our heads. Numbers are a relatively recent phenomenon in human history, 5,000 years or so at most, and our brains have not fully adapted. Put onto this the fact that probability does not work the same way that math does. The probability has different properties than addition, subtraction, multiplication, what we think of as normal mathematical functions. And things like cumulative probability are just very difficult to wrap our brains around. I know for a fact myself, I've taken stats classes. Probability is a regular part of my day-to-day work. And I have almost no ability to do cumulative probability calculations in my head. I have to work through an Excel spreadsheet and figure out, okay, over 3 iterations at this particular probability, what's the cumulative probability of something happening? If you were to ask me over the course of a 30-year mortgage with this 1% rate, what's the aggregate or cumulative probability of experiencing one flood? Yeah, I couldn't tell you. I know it's not 30%. I know it's not 1%. It's somewhere in between there, probably. Maybe like 10%. That would be my guess, my estimate. And of course, we know that's not correct.
Yes, and I'd have to say, and I'll probably lose my actuary card for this, but I also have the same problem, and I have to go back and think about it. In fact, in preparing for this podcast, I had to work through, oh, how did they get to that 26% number? I did manage to, don't take my card away, I did manage to work it out, but it is not intuitive. And in fact, for those of you, for interested listeners, the way that you calculate it is you first calculate the likelihood that there are no floods over the next 30 years, which is calculated by taking 1 minus 0.01, which is 0.99, and compounding that 30 times. So taking that to the 30th power. That is actually how you, and then you take the complement of that.
The one
So
minus.
the
Okay.
1 minus. But that's not intuitive. To your point, John, that is not intuitive to people. That's not even intuitive to me. And I've been studying, I was a statistics major in my undergrad work.
And I think this all then further emphasizes your earlier point that just providing more information is not going to move the needle.
No, it's too slow. And going back to one of your favorite hits, which is the efficiency imperative, nobody wants to spend the energy trying to figure that out, except geeks like me.
So there are clearly lots of issues around this, and we've talked around some general solutions that the NFIP could employ in terms of driving greater uptake of policies, greater purchase of policies. To me, two of the clearest are working on people's perception of the value of their own property, making them believe or feel the worth of their home even more than they already do, and amplifying the salience and perception of the events themselves. Informational messaging will not really do anything for either of these. It has to be something that speaks to the internal probability assessments and internal valuations that people make of events and of their own assets. And Rich, I know you have some thoughts around incentives and structuring of the programs themselves.
Yeah, I think trying to make this stand on its own as a self-sufficient program, you can do it over a long period of time. But I think in the short run, the bigger issue is getting that spread of risk. And therefore, I think doing that through increasing coverages by offering various types of incentives, maybe discounts for certain home improvements that reduce the risk of flood, having people build certain things around their homes. You have to find ways to make this worth their while that both brings the thought of a flood more concretely into their mind and at the same time rewards them for doing things that actually mitigates against the actual risk of it occurring so that there's a win-win, right? Because we want a program in general that's going to be one that is self-sufficient, that is going to get uptake, that is going to be valued by the people who buy into it. And the way to do that is by encouraging risk management by homeowners themselves.
You brought up the notion of making it a win-win. And I think in terms of how we look at this, and especially how policymakers look at this, we have to remember that this is not really a win-win. There's no scenario under the current structure where we can land on a win-win. It's really more of a loss, smaller loss, as opposed to a win-win. And this is naturally a hard sell. Sure, we can introduce incentives so that people pay less, but as long as people are paying, it's still going to be perceived as something people don't want to do. And I think that's really the foundational problem we have with all manner of insurance policies. We look at all the ones that are regulatorily obliged, car insurance, homeowners insurance, in limited instances, flood insurance. And people purchase them because they're required to. And if you take away that requirement, what we observe largely is that people don't. I think there's a really interesting lesson here. If we look at one purely voluntary insurance type that has actually seen a reasonably high uptake of purchases, which would be life insurance. And life insurance made a really intriguing development. I'm not sure of the exact time frame, but I want to say 20 to 30 years ago with the idea of living benefits. And you would talk about incentivization. I think that's incentivization. Reducing how much you're going to pay isn't really an incentive. That's just, I'm reducing the pain a little bit. I'm not sure what the living benefit analog would be for a flood insurance
Oh, I
policy,
know exactly. I know exactly what it would be, which
but
is
getting something, actually receiving something that you perceive as beneficial would have an enormous impact on driving uptake.
yeah, and this gets into the whole thing. We could do a whole separate thing on insurance in general. But what some behavioral economic studies in the insurance arena have shown is that rather than offer an upfront discount, offering some type of dividend or payment back at the end of a given period, if experience is good, allows folks to think, okay, well, I didn't use my coverage, and therefore all I needed to do was make some type of contribution, and I get most of the rest of my money back. Doing that can definitely be something that would incentivize folks to purchase it. So going the other way, it would have the same impact as a discount if you really step back from it, but the perception of it would be different.
Absolutely. And this comes to, well, we're jumping into a new topic, but framing. That is to say, you can position the same factual information as either a loss or a gain, and the way people perceive it and process it and calculate it will be different. That probably warrants its own conversation in a future episode.
Yeah. And the last thing I'm going to bring up that could be done is, again, something that I'm sure we'll spend the whole podcast talking about, which is leveraging bias. And in particular, what we've seen in certain European countries, particularly the UK, is that flood is bundled with other perils, other events that could drive a claim to occur, so that there's more, again, spread of risk across a number of different risk sources, and therefore becomes more palatable when taken as a whole.
The NFIP has lots of challenges around it. Some of them because of these structural issues and the ways that it is put together. Some of them just because of the way that people think and make decisions. It will need to resolve these in the coming years in order to have some level of stability and solvency and to be available to residents and taxpayers year over year. This will be increasingly pressing, most likely, in the next 1 to 2 decades if climate change continues as it does and flood likelihoods, especially in coastal areas, continues to increase. Given what we do know from the behavioral side, there is reason to hope. There are ways that the NFIP can position itself and improve its outreach and engagement and positioning among residents and homeowners. But that's going to require a will to change and to embrace new approaches beyond simple marketing and communications. Whether this happens or whether things remain as they have been for the last 20 years, well, I think that's a probability assessment that none of us are really equipped to make right now. Thanks for joining us, and we look forward to talking with you next time. Behavior and Risk is brought to you by Capita Solutions. Behavior and Risk staff includes our research team, Sherry Xu and Jin Zhang, and our editing team, Jingying Gao and Athena Liu. Theme music by Crypt of Insomnia. The opinions presented here are solely those of John Burkhart and Rich Loria and do not represent those of Columbia University, Capita Solutions, or any other organization. We thank you for taking a chance on us today.